Hello guys, glad to have you on board again. Today we're going to do something a little bit special. It's still going to be an expert only, so experienced traders in here. Please, no beginners. These things we're going to talk about, even though they might be really passionating and catch a lot of interest for you, please don't listen to this. All it can do is just basically force you to take risks you're not willing to handle. So these are once again reversal trade, anticipative trading, things that requires knowledge, money management, to have figured out most of the natural biases impacting into trading. So all of those things require maturity in trading. If you're just there trying going down these roads without being fully prepared or ready to face the eventual downside risks to these scenarios, then you're just going to go down very nasty roads, and whatever can come next can hardly be good and profitable if you're just facing problem without being prepared for them. So it's not that I don't want you to profit from these things. It's just mostly if you do it the bad way, if you do it the wrong way, just bad things can only happen from this. All right, so bad decision-making processes, hopefully no losses, but I just don't want you to go down these roads because there's nothing to be learned out of this if you're facing them being unprepared. So experienced only at that stage, still the usual warnings. If you keep on watching that video after the warning, your own responsibilities are in the motion in here, and if you dare listening to this, you're going to feel like you want to do it, and it's going to be a stupid decision. Anyway, so you experienced traders know what this is, know the natural biases, you know what risk management is. We're not here to forecast the future, just assess some probabilities and expose our capital regarding to those probabilities and risk managements that we have. I'm obviously talking here about reversal trade, which means anticipating a market switch. How violent could be that switch, what happens, whatever. So today I'm going to be talking once again about the big old problem we're facing right now with the SPX. Because obviously that's a big area for concern myself regarding my personal exposition to the markets, what I'm trying to do, why I'm doing it. So you know I've been making significant numbers of video, but today I'm going to be doing something a little bit different, like explaining you in terms of macroeconomical projections what I'm trying to do, because you really need to understand that my job is not necessarily to know what the hell is going to happen. My job is most likely replicating what professionals are doing, what I call the smart monies. All right, so the guys who have been working in finance long enough, or working into investment funds, equity funds, whatever, just professional traders. All right, my job is to anticipate those guys by using the same tools they use, risk management, and basically trying to do what they do as they do it, so I can try to replicate their job, and once I get validated, I can safely apply a little bit of leverage, which means I'm going to expose myself to the market with capital I don't have, which is obviously leveraging positions, but just a bit. Like I said, over leveraging is just as stupid as it can be. You know this, so I'm not going to go down this road. All right, so putting an appropriate leverage without ever risk taking, which is my job, like accumulating multiple speculative positions. So when the trend period, the trend cycle triggers, then I get to be overexposed, which means I've got more money in the market than I actually own. But I've never taking risk on capital, like always. Like adding 1% risk one after another without ever getting above this 1 to 3% risk, which is the maximum scale I'm generally using. But I use the 3% risk taking when I'm really confident. I'm clearly not right now, which means anytime I try something with Wall Street, I'm either 1% or sometimes even below that, obviously. So really tiny risk taking, because the risk is obviously significantly high. And regarding whatever I might be thinking, what I see and what I've seen over the latest 2 years, I've just gone the opposite way, or not necessarily the opposite way, but didn't validate. So as I can't find validation, means I'm also facing potential invalidation. So invalidation, you know, is part of every reversal type of process, and that's obviously something you need to account in your risk takings. So let's cut the crap and go straight to the essential. What I'm going to be talking about today is how midterm to long-term reversals are working out, and what is talking about smart money. Obviously, I tell you that the smart money is not the same, is not the only market profile impacting prices. All right, this is what I think the most impactful, because most of the money is spread out through different asset classes by the smart money managers, I mean, so far I don't see any way this can change, but maybe in the future. But nowadays, all right, though these professional asset managers tend to work out using a cyclical behavior. So we're going to try to explain in great detail today what that pattern is. We've already been talking about these things, so I'm just going to translate. Right? This is growth, distribution, and investment. So let me just go ahead. All right, so this is the growth period. This is distribution, same word, and investment. All right. So the thing is, I'll explain what are the other things afterwards and whatever are those boxes. But just considering that as this is the capital allocation for a fund manager, so a smart manager, smart money guys, the way I call them. Once again, don't take that bad. Doesn't mean those guys are better than others and all the others are dumbs. These are just words I've been using to make it easier for you to understand. All right, those who don't necessarily trade this way are not necessarily dumb, but I do call them dumb money just by opposition to the smart money, because over the time, these are the guys that are moving the money, so these are the guys that makes the decision. But anyway, so considering out like this is 100%, like considering out as a spreading, oh, God damn it, portfolio value is 100%. All right, of an asset manager, typical asset manager. So we're doing averaging in here, right? Obviously, there are different managers who have different profiles. Some are more aggressive, less aggressive, stuff like that. But let's take that as an average belief among the managing community. So this is how things go as we go throughout the economic cycle, all right? So this is the exposition throughout different asset classes. Right? These asset classes, I'll explain what those colors means. All right, and this is the three major phases into an economic cycle: the growth phase, distribution, and investment phase. All right, I haven't been putting them into the right order. All right, I could have, normally we start with investment, then we get growth, and finish with distribution. All right, but anyway, it's a cycle. So we go investment, growth, distribution, investment, growth, distribution, investment, growth, distribution, and so on. All right, we never go on the opposite direction. It's still the same old thing. So basically, we put in the money ahead of the economic cycle. We're financing the future growth creation processes. We're putting money out there to give money to those who will create stuff, create new things, create progress, create growth. All right. Though they grow, they create the fucking things they've been paid for, and things are moving on. We're creating new things, we're making discoveries, we're creating new products, people buy them, we create growth, whatever. You know the cycle, right? Generally, this is the longest part in the three cycles. Then gets distribution, which means those who've been creating growth are reaching top-notch, and they can no longer be innovative or creative, or they're just they've been reaching the market limitations, all right? So growth has a limit, and this is what you need to understand. This is in the structural behaviors of market. Remember that markets, the way we call them with a big capital M, is just the thing we created to spread the money out there in the most efficient way. That's the definition of markets by themselves in a capitalistic way. We use the market to naturally spread out the money into the most efficient way so that $1 can create the most potential growth during the economic cycle. So obviously that's theoretical, but I would say it has its pros and cons, but it doesn't necessarily work that bad. So this system is somehow the one we currently are dealing with. Maybe it will change in the future. We're not here to assess that right here, right now. But let's assume this things will keep on going. This capitalistic system of spreading the money out there throughout economic cycle of producing new stuff, then obviously the growth actors are changing each and every cycle. This is why we've got a distribution phase and an investment phase in between. All right? And you really need to understand that there is no growth if there is no distribution and investment. It's absolutely necessary because we cannot create growth by the same actors all over again, simply because growth actors already reach a top market limitation, which means when you got the best out of something, let's just take the example, Apple, smartphone, whatever, all right, they reached out the top. They can't go anywhere higher than that. There's no more innovation in those cell phones. You can try to make a bigger camera, a bigger screen, whatever shit that is. You're not going to revolutionize cell phone tomorrows. This revolution is the one that has been going for this freaking cycle. All right, so Apple has been a growth participant and one of the most significant one throughout this economic cycle. So now, what's next? Do you really think we're going to have much better phones in the next economic cycle? Definitely not. So the thing is that this is why we need to distribute the money. As the money has been created throughout growth processors, Apples and stuff like that, we're going to have to distribute the money, which means profit fucking taking, lowering the valuations of those companies so we can get cash to fucking invest. All right? So if we want to create tomorrow's growth, we need cash. And in order to get that cash, we need to fucking distribute, which means selling those assets. Just to take the dollars to put them elsewhere. And what people don't get today is that they think growth is going to magically show out of nowhere. Like, all right, we're lacking of growth, but that's just because Trump is bullshitting out there. So the growth contraction we're having right now is not because we're lacking of investment. It's simply because Trump is bullshitting, but it's going to stop, things will be fine, and the business will go as usual. Just how stupid that thinking is. Every rational asset manager knows how things goes. We take the money, we put it elsewhere, we create new money with that, we take it, put it elsewhere, take it, put it elsewhere, take it, put it elsewhere. This is how this goes. This is how it's always have gone. And it is not just about the recent capitalistic stuff. This is how capital assignment has been working all along. Things are moving. Things that create growth are always different. So nowadays, people tend to believe, stupidly, that those who were creating growth previously will create tomorrow's growth as well. How stupid that is. So it's possible, all right? Because obviously, Apple doesn't have to work it out around smartphone forever. They're trying to switch to other things. But people tend to believe that they're going to win. Do you know how difficult that is to be the growth creator? Like when it comes to the investment phase, you're not investing into one company. You're going to invest into, like, not necessarily 100, but close to, like I said, 50 companies is what you need to invest on. If you want to catch up the growth creators, those who are going to multiply money by significant numbers, yeah, that's how it goes. But catching those companies is freakingly complicated, which means you really think that someone who's been making it for one cycle is going to make it the cycle right after, knowing how difficult and how low the probabilities are to make a perfect hit right into the future growth sector. It's really freakingly complicated, but people nowadays just do what they do at each and every economic cycle. Just like I told you, I usually take the General Electric example in here because that's the one that speaks the most to most people. General Electric back in those days were the pioneers. They were the one who created so much growth, selling widespread products that people were thinking that any fucking way they'll be among the next economic cycle. We didn't know what the next economic cycle would be about. We clearly didn't know, all right? We just knew that General Electric's in the in the internet bubble and stuff like that was like, all right, General Electric will obviously do much more connected stuff and whatever. So it's going to be a revolution. And anyway, we don't know yet what's going to create growth, but General Electric is going to be among them. It hasn't. Now we know it. It just simply hasn't been. So what is going to come is just simply something you cannot even imagine. So why the hell would you just bet that Apple will make it out there? That the fact that they're launching whatever this is, Apple TV or whatever, that is the future. I simply think it's not. At least the odds for this to be are pretty fucking rare. And even if they manage to make a match, is this match going to be comparable to what they've done with the iPhones and those things? I doubt it. You rarely do twice the perfect shots. Simple as that. So I wouldn't bet on this. Though I think what we need right now is to really make a distribution phase to go over investing elsewhere. If we don't have growth, it means that the next growth sectors are probably lacking of money. So that's what the normal things goes. After growth, people take money, so they get prepared to reinvest elsewhere. We generally have a market contraction throughout the distribution to investment phase. It can be faster or slower depending on how the money were distributed previously, like how the money were spread throughout the growth phase. Just makes it a more violent distribution phase or not, depends on if bubble were created, how deeply we went off the valuation and stuff like that, so how brutal the back to reality move can be. I don't think we're in a catastrophic kind of pullback. Like I said, I think we're overvalued for 30 to 40% on some asset, no more than that. And that's the worst case scenario, so it can be less than that, I think, in some possible ways. But what we're living right now is that, let's take the example of, I think what we're living right now is the exact replicate of 1987, in which we're mature in the economic cycle, but people tend to believe that the previous actors will be tomorrow's ones, which is exactly what was happening in 1987. And we had a brutal distribution of money throughout this ugly crash we had. But I think it was necessary to create the forthcoming growth, though the 2000 bubble. The internet bubble has emerged because of the redistribution that came after 1987. And if 1987 never existed, then we never had that much money available for internet and stuff like that, because the distribution were pretty messy, but there has been some distribution. And it was necessary. So I'll explain what the distribution system is afterwards. And I'll explain how today's new paradigm is altering it, but I just think it's a dream. I'll explain that, all right? So now let's go into those things to start the process. So this is just like a partial allocation of money throughout those different sectors, all right? So the red is obligation, all right? So debt. Financing states or corporates, like lending money to someone else, all right? So all the asset managers are using this. They're lending money to other part of the economy. So either they're lending to governments, or they're lending to corporations, or they're lending money, all right? The black is the commodities. Like what most funds are doing is that they're buying stuff and they're speculating on the prices of stuff. Like our prices are going to go higher, though we buy those things so we can sell them later at better prices. So they are buying commodities. So they don't do it that much, but at the beginning of the growth or during the growth, they tend to buy because prices will increase. So they're buying some of those stuff. They buy and sell, buy and sell. It's not necessarily a buy and hold that happens with commodities, but it's just generally fund managers tends to finance big buys of those things that they generally retail sale afterwards. So they're buying big and they're selling tinier portions afterwards to companies who are necessitating those production capacities. Remember that we're creating growth, because of what we use. The commodities are creating those growth most of the time, unless for services and other sectors like that. All right, but generally this is how it goes. Though we're buying some assets to sell them to companies so they can create growth and we can get value out of those companies. The yellow is simply refuge assets, safe assets like precious metals, safe havens, like we just store part of a capital in here. I totally forgot real estate, which is important, but I don't really go down this road in here because that's a specific part of it, and generally some funds are specified for real estate investment, and they generally don't do global type of investment. Though we generally see we've got asset managers for let's call that market asset managing, and real estate is something different because it's less liquid and stuff. It's a particular way, though I don't want to put it in here. So real estate's been set apart. Here is cash, like pure cash. You keep on cash in the account, being able to buy some other stuff. And this is stock behavior. So when we get into a growth period, most asset manager, all right, though this in here is the average. All right, now let me just explain. This is, if you take like all those things, growth, distribution, investment, this is the average exposition. All right, so you get to understand, because what you need to figure out is not necessarily how things go, it's just how specific is the profile of the growth period regarding the average exposition of an asset manager. On the average, an asset manager generally have twice the amount of stocks that it has in investment into credits. All right, so is lending some money, but is having more money poured into stocks. Obviously, it's a generalization I do in here. Some asset managers do quite the opposite, but they are called bond manager and they have much more bonds than they do go on the stock market. But in a global perspective, this is most likely, I think, accurate to the reality. But don't take that as a precise thing. What's important in here is the movement afterwards. Though in here in the growth period, we're underperforming lending, which means we're most likely want to make money. Remember that the goal for a fund is to make money the most efficient way with the lowest possible risks. So on the growth period, most asset managers think that they will make more money by using stocks, so using rise in valuation from stocks, production makers like companies and stuff like that, all right, that they will do by lending money to those companies. So they still do lend money, all right, but they are far more getting into valuating them, getting into being portions of their capital, all right. They generally tend to buy a little bit more commodities than the average in the growth periods because there are lots of demands for those growth things. So when the prices are cheap, they're instantly buying it and selling at higher prices. They generally underpin the safe asset just slightly, right? Like they do still have a little bit of gold and stuff like that, but in a very narrow perspective. During the growth period, people are creating wealth. You want to be part of it. So you don't want to have that much gold, all right? And cash is significantly reduced to its minimum. Most of the cash must be invested, and most of it goes to stock market buying, all right? So you need to understand that. Now in the distribution phase, which means after the growth period, when people have been putting everything they can from the money creation system, which is spreading money, creating stuff, creating GDP and stuff like that. So when those companies got at the best of what they can do, like the best cell phone, the whatever, innovation has limitation, and technology also has its own limitation, all right? So when we reach out the rooftop, the market limit, then when we get there, there's not enough money to pick from growth. So this growth cycle is nearing its end when we're reaching top innovation, and we can't necessarily innovate more and stuff like that. We get limited. When we get this, growth is contracting, though the economic cycle is reaching its end, and we need to distribute, to invest, and prepare the next cycle. Distribution is absolutely necessary to find the next investment phase. So if we want to create growth in the future, we need to distribute and invest afterwards. But what happens today? People tend to believe that the distribution phase is not good, we can do it better. So this is central bankers who just decided that we weren't distributing the money the right way. They know it better than we do. So they just decided to get in there, to just make this transition smoother. That's a possibility, but we'll get to another complex problem afterwards. So after growth, what people tend to do is that at the end of the economic cycle, when the potential for valuations to keep on rising are really limited, what they do is that they shrink, they sell most of their stocks. In here, they get it down, and what they do is that they cross, which means the major class switching that we have when we get to come closer to the distribution phase is generally this, which means the money from stocks goes in here. All right? This is the major transition. The other transition is that generally we sell commodities to get to buy safer assets. And most of the stocks are either buying a bit of bonds and buying cash, which means keeping a little bit more cash than we did in the growth distribution. So this is the most important things that gets the asset moving, that goes when we are entering the distribution phase. Most of asset managers are selling their stocks to buy and to keep some cash, some higher portions of cash, and they generally tend to buy more bonds. All right? And in the meantime, there is somehow of an equal process that goes from selling most of the commodities because they anticipate the contraction phase, not necessarily a recession, but just less demand, which means normally less consumptions of those goods, so less demand, though we're selling them or we're having less of them inside our portfolio, and we generally tend to buy more safer assets ahead of potential risks and demand for those safer assets. All right, so this is the major switch that happens when market goes from growth period to distribution periods. When the distribution happens, generally stock markets goes down because less demand for riskier assets means their prices are going down, right? But that's the thing that the central banks doesn't want to happen right now. We'll discuss about that later. And afterwards, when the distribution phase has happened, when we go investment, the major movement is that we sell the bonds to get to buy more stocks, all right? We increase stock exposition into the asset management. We generally tend to use cash, generally tend to use gold to buy commodities again, and we reduce gold exposition to the minimum, and we get to buy more commodities, and we generally shrink a little bit as well and use most of the cash to invest. This is the global way to distribute money among asset managers, all right? Selling stocks to buy both bonds and keeping a little bit of cash ahead of future investment, using that money to invest in stocks, using the gold to buy some commodities, and selling the bonds, the safer bonds. All right, we generally has a switch inside bond in here. I'm not going to go down this road. All right, this will explain the rotation throughout the stock market. There is a rotation as well into the bond maturities in here, but I'm not going to explain this today. What you need to understand is how portfolio allocation is working throughout the growth, distribution, and investment phase. And these things are cycling. Remember, we do this, this, and this, and this, and this, and this, and this is an endless cycle. All right? So that's how it goes. You really need to understand this. It's the key thing. Now, this is what we have nowadays, which means this is what we should have. All right, this is where we should be right now. We're in a distribution phase. We're terminating the economic cycle, and we should heading to a distribution phase. But some people decided we're not going to be doing this. This cycle, this endless cycle stuff, we're going to change it. I can't explain why, but just simply people don't want the stock market to go down. So if you don't want this movement to occur, which means if you don't want the stock market money to go in there, how can you alter things? What are the central banking system interventions I've been doing over the latest years? As the cycle has been getting a little bit more mature, right, people were rotating into bonds. So basically the Fed was the first one to do, and they've been injecting money throughout the growth system, which means in here it was pretty well targeted and it worked pretty efficiently, because that's good. What the thing is that we were lacking of growth in 2011, 2012 because of the wounds that people still had coming from the 2008 crash. We were lacking of investment, all right? So the central bankers have been forcing people into stocks by forcing the investment to growth shifting, all right? Remember, that's a cycle. We go from there to there, to there, to there, and this one just pulls us back in here, and we start all over again, All right? So the problems we had in 2011 and the reason why the central bank intervened in the first place, which was smart, and I stand on this, it wasn't a bad decision if it's well timed. The problem is what we're doing nowadays is a big problem because we're trying to use the same tool in a totally different market behavior. And this will produce significantly different reactions, but we'll get to this later. So lacking of investment to produce growth is what we were facing in 2011 because the crisis has been causing confidence problems. So the central banks has intervened, and they had to, and that was a smart decision. What they've done is that as we were there and we were wanting to go there, that we needed more stock market investment to create wealth and growth. So people were not willing to invest as much, all right? So we were somehow with the least investment structure, and we needed to go toward this. So we were something in between those two. We were like that. We were there, and we had to be there. So what we needed is to shrink market makers' exposition to bonds. We needed them to sell their bonds to buy stocks. The problem is they weren't doing that much of it. We wanted this money to get there. So that's what the central bankers wanted to support economy. They wanted the asset managers to do this thing, to force them doing this. Use the cash and use the bonds to get to buy stocks. So in order to do this, as the asset managers just didn't want to, all right, the central bankers have been saying, all right, you know what, I'm going to buy this from you. I'm going to buy that, and with that portion that is no longer on your balance, I'm going to give you cash. I'm going to give you way more cash than you need. I'm going to give you more and more cash at the cost of your bond markets. So I'm going to buy your bonds and I'm going to give you cash. And with that cash, freaking fucking hell, you're going to buy some stocks. All right? That's what the central bankers have done. 2011, 2012, and it worked fine. People were getting into riskier assets, investing in stock because there was no choice. The central banker were putting a lot of pressure on bonds to force investors using their cash elsewhere. All right? Now, the central banker, you're using the same tools nowadays. Monetary accommodation, buying bonds. We're not yet buying bonds, all right, but they're trying to. At least that's what we do in the ECB. So it makes absolutely no sense. We're here today. We're in the growth period. We're getting into distribution. So what we should do right now is this. So if the central bankers want to prevent this move from happening, which is exactly what they want to avoid the stock market to purge. So what they would like to do this time is buying stocks. Would be the central banker just takes it out and gives cash. All right? That would be the thing. That would be buying stocks to give some cash so that investors can finance investing in bonds safely and go safe and then wait for the distribution. But the problem is when you do this, you're just fucking up the entire process. That's what people think right now. Most of some asset managers tend to believe that what we've done as an experimentation, as an experiment with the bond system by monetary intervention from the central bank is just one part of a process, and that the second part will come later, and that is buying stocks to avoid the stock market collapsing. Not necessarily collapsing, but avoid the stock market going down. I'll explain later on, but people tend to believe this, and that's a big problem, because if we do this, we're simply killing the investment phase, because it's destroying the nature itself of asset management. Because that means when we create growth, the central bankers are buying the expensive stocks that created growth, so they give money to asset managers so they can buy other stocks, right? And they can rotate the monetary creation system. So instead of taking profits from those riskier assets, they're going to sell them to the central bank. That will do, all right, these things have been creating a lot of money. They're going to lose valuations, but no problem, the losses are for us. We're going to buy those assets at the most expensive prices, and when they'll drop, we'll take the losses for you. That's great. If that's the future of investment, then believe me, investment will lose its entire purpose. And we're just going to kill investment by doing this, because investment comes with a risk. If there's no longer risk taking, there's no longer money. We just destroy the entire value of money and the investment. If you can just be given money to invest wherever the fuck you want, as long as you can find the growth sector, you're great, you're good, you know that you can take the entire amounts of risks ever created, you're never going to suffer the risks. Like, you can buy the assets even if they're crazy fucking expensive. The central banks will buy them for you. So if the shit hits the fan, central banking system will take all the problems and you can take all the risky profits. Now, simply, if you go down this road, I can tell you that what we're going to have next is not going to be pretty. I don't even think with this we're going to do this, but some people tend to believe this is the future. All right? So this is the problem we're living right now. Into explaining that problem, we need to dip further into what the problem is with the stock market pricing we're having right now. And in order to do this, we need to dig deeper. So I just basically took those boxes, like this one, and this one, trying to explain you and digging a little deeper into this, explaining this into two ways, which I call value stocks and growth stocks, because this is important. That's the rotation you need to understand. When I say after growth, we need to go distribution and investment in order to create growth afterwards, all right? In order to do this by distributing and investing, all right? If we want investment to create growth, they just can't be into the same stocks, into the same companies, because things are evolving. New assets will create new value and stuff like that. Now there's the new paradigm in which we've got big companies that become so big to fail, so too big to fail, that they will create tomorrow's growth anyway. I think that's a big fucking mistake. Like I said, GE type of mistake, thinking that anyway this company is too big, that anyway is gonna be creating growth tomorrow as well. Yeah, probably not, because I mean, the past are just here to tell about that. Big companies always have been replaced by other big companies. Otherwise, the Rothschild will be #1 today, and they're not, because they've been split altogether by the back in those days. And it is it. When we've got too big to fail things, they generally tend to be dismantled. So people tend to believe the next big move is to buy Googles, to buy Apples, to buy things like that, because they are the big ones and they're going to be there forever. They're probably going to be dismantled, and we're going to just switch to other monetary creation system, because if we want growth, that's how we'll get it. We need to have other actors, and in order to have them, there is no other choice but to dismantle those things. We'll do. I'm pretty sure we'll do. It's just a matter of time. And yeah, there is the political will. Like, just ask someone in the street if they want to dismantle Google, and if they think it will be great to dismantle Google because they're too powerful, or to dismantle Apple as well. I never say destroying those companies. I just say dismantle, which means we just, out of a very big and powerful company, we create many smaller companies still handling the same activities. But it creates competition, it recreates evolution, innovation, growth. That's how it goes. If you want to create growth in the US, you need to dismantle the Googles, you need to dismantle the Apples. But, I mean, people just think anyway these things will evolve and create growth tomorrow. That's not how it works. History is just proving us it's not how it worked in the past. That doesn't mean it isn't going to change. It just says, statically speaking, I would like to bet on the opposite. So anyway, let's explain how it goes. So value stocks, growth stocks are in blue, and things are explaining how throughout this process of distributing and reinvesting we get this. All right, and as you get to understand, out of the investment phase we do here, we create the future growth and then we distribute, which means those assets in here, those who created growth, need to be sold to buy other assets to really fulfill this thing. And this is how this rotation goes. Generally, when the growth period goes in, all right, asset manager have a full exposition to stocks. This is where they have most of their portfolio allocation throughout stocks. Throughout this allocation, they have generally like an 80 to 20% allocation between growth stocks. They're overperforming those who create value. They're buying and buying and buying more apples as the growth goes in. They're buying the pullbacks of those companies that rise in profits. But they don't do it out of nowhere. They do it out of reading this asset performance. They taking the earnings release and they seeing, all right, this one is making better profits than we expected. It's in a growth sector. So yes, we're overperforming. We're buying more of those stocks. All right, that's how this goes. Overperforming, underperforming. So we're overperforming growth stocks and we're underperforming value stocks. All right. Though we don't buy them, but we buy a lot of them. But that doesn't mean we're selling them, all right? It's not blue to buy and red to sell. It's not like that. When we get to the distribution phase, what we tend to do is, out of the previous thing, we tend to sell part of our growth. We keep on having them, all right? We still not sell entirely. We sell part of them, all right? But we generally divide at least by 2 the growth exposition actions into a portfolio, but we keep some of them for long-term investment. Just like I said, Apple's not going to disappear. Even if it gets split up, it still will be a valuable company. It will still be interesting to have part of it in your portfolios, if you have, obviously, a managed portfolio. But what generally asset managers tend to do is that at this moment, they tend to buy defensive stocks, the value stocks. They are overperforming value stocks, and they're downgrading growth stocks. This is the distribution phase, all right? And then what they do is that after selling the growth stocks, they're buying other growth stocks, all right? This is blue, but this is just when they do buy this, they don't go buying full Apple and full Amazon at the beginning of an economic cycle. Just like I told you, the thing is that in here we generally buy many assets, like generally 50 to 100 assets. We're betting on the potential growth sector. So this is all the power and smartness of the money manager, who's going to try to pick up sectors who likely will be the growth creator of the next economic cycle. In the investment phase, we speculate on what will create growth. And during the growth period, we adjust, meaning that let's say in here you bought some Caterpillar, Apple, whatever. All right, you anticipated the next growth system, so this is out of anticipation in here. And when the growth goes in, this is where you adjust, all right? You're going to sell what doesn't work, or at least you're going to underperform the low growth producers, and you're going to overperform those who actually get to create growth. So you speculate, and those in which you were right, you're going to buy more. Those in which you were wrong, you're going to sell a bit, all right? That's how it goes. We allocate money throughout the growth sectors, and we give more money to those who actually create growth, and we just shrink the money allocation to those who are not. But investment phase is absolutely necessary because it's like a reset button. It means we were concentrating money, we are deconcentrating in order to bring back competition. All right? In a capitalistic system, the basis of the system's thinking is competition is key for a wealthy market. What we're doing today is destroying competition. This is the problem that the central bankers have been creating. By destroying this, all right, what the money manager are thinking today is that they're thinking, what the hell would I need to sell my apples and stuff like that? Because if anything goes wrong, I think that the central banker will buy my shares. So the problem is every asset manager in here today just knows one thing. All those assets are illiquid, which means most people have them in their portfolio, but the value is pretty undecisive because if we try to sell them, we're not sure that we're going to find buyers. Just like I said, if you got like 200,000 Apple shares in your portfolio, they don't worth 200,000 times $262. They worth what you'll get when you sell those 200,000 shares, and it is likely going to be far less than $262 per share. So the problem is we don't know how much they value, which is a problem. All right. So it creates this kind of system in which lots of people have it. In the future, less people will have them. All right. And there's not enough space for everyone to get out. That's the problem we're having right now. That's the problem every asset manager knows about. They know that we're all here, they're all there, they're not selling, all right? And they know that if they have to sell, they all do it in the same time, which means out of 10 participants, just probably 3 or 4 will manage to sell at a decent average price. All the others will significantly have drawdowns, which means price drops because no buyers to buy the stocks. And they're significantly hoping nowadays that as the central bankers have been helping to distribute have been helping into the bond sector, then they're probably the next move is that they'll help with the stock markets, and that they're obviously going to have to buy the riskier assets to avoid a market crash. So in order to avoid the apples to significantly fall like shit, they're going to be buying Apple. So what people expect is that, yes, this is the current context we are right now. There's not enough room for everyone to get out. But what they expect is that if we go there, and if just 3 people have managed to get out, right, like assume those 3 have gotten out, all right, all those 6 guys left behind will be bought out by the central bank. That's what they expect. They'll say, all right, no worries. If things are really going out of control, we're really lacking of liquidity, central bank cannot just let that happen. They've created it, so they got to solve the mess. That's a really, really big assumption made out there. Because, first of all, you don't know. You're taking a very dangerous bet, because if you fail, you don't know how much you're going to get. Like I said, it's a $262 today. All right. That's great. That's the price the guys can get, but only those 3 guys can get that. What happens with those 6 guys left behind, or 7 in this case, 7 guys left behind, if the central bankers doesn't show up to support the prices to the upside? If the central banker doesn't show up to buy those illiquid stocks, how much will they sell them? 180? 120? Who knows? But it's going to be far significantly lower than the $260 that it's priced in today. So that is the problem we're in right now. We can't necessarily value those things because some people tend to speculate that anyway, if it goes bad, it can't be that bad because central bankers will be there to save our assets. That's a dangerous bet. Obviously, not all asset managers are doing this, but some are doing it. And that's the current motive. The current motive is we're all there. We hope that we're going to be those who are going to be able to get out first, but we can't be the first one to trigger, right? Like we can't be the first one to go out there. We wait for someone to get there, and we hope to be the second or the third, but we know that there's not going to be some 4th place, 5th place, and 7th place. All of those guys will end up being saved by the central banker magically to avoid falling like shit. So that's what people hope, that the riskier assets, those who were creating growth specifically, will probably be bought by the central bankers, because if they're not, we're going to have a financial crisis. So they making the dangerous assumption that the central bankers doesn't want a financial crisis. So if we take the risk, don't take the money, which means if it works out and if the apples and this and stuff like that doesn't go down, then we're going to take the profits. Like I said, it's not the central banker who's going to make the profit if apples and stuff like that are multiplying by 2. Like if the 262 we're having today is not enough and we're going for 300s, then whoever is owning the stock is going to make the gains from 262 to 300. But what they think is that, all right, if the gain is there, I'm going to take it. And if the shit hits the fan, I'm not going to pay for it. Since then, the motive is really dangerous. Like I said, we're losing value because what we're doing in here is that we're pricing in gains or potential gains without pricing in the potential risk because we think someone else is going to pay for the risk. I don't nearly think that's what's going to come over. People believe it is. They rather like to think about it because that's great. That justify risk-taking. Saying, I can risk-take. Someone else is going to take care of the risk if something happens unexpectedly. Believe me, I think it won't be the case because there are some legal purposes in here, and I don't nearly believe the Fed is ready to buy bonds, to buy stocks. Most likely because, yeah, some other banks have been doing it. The Switzerland Central Bank, Japan. This has been an experimentation elsewhere. But if we do this, the stock market itself just loses its purpose all by itself. Competition is the market's goal. If we destroy competition, end of story. I mean, the economy will significantly change, which means the market structure will change as well. But the problem is people tend to believe that economy makes the market change. And now what we're doing today is that we're changing the market structure, hoping that the economy won't change. That's as stupid as it is. If the central bankers are altering the market pricing, believe me, the economy will change as well. So you can't just play the good old games. So that's a dangerous bet on the future. We're going to have the same old economical system creating lots of growth and whatever with a new market participant that is altering the market structure. I don't believe this thing because it simply feels as irrational as possible. So that's the new paradigm, that we can take the best out of central banking, which means we can risk take, and they are going to take the risk if the shit hits the fan, and we take the profits. Yeah, great, do it. What you do is that you're going to concentrate money to some few actors. What you're going to create afterwards, monetary concentration, we're going to slash those companies. We're just going to just dismantle them. That's the only possible future. I think we're more likely to dismantle the Google and Apples and stuff like that than having the central banking system buying it. And if the central banking systems are buying it, you're going to have hell of a political problem. And I can tell you that. It's going to be a huge political problem. Because if you do this, you're going to increase the wealth gap, and you're going to have political problems. You're going to have people in the streets. You're going to have riots and stuff like that. And it's not funny and it's not pretty. So I think that people are just hoping for the best because they just don't want to pay for the risk taking. Though they're taking risks, so I tend to believe that anyway. I think a financial crisis is down the corner in the US. I think it's going to be a fast and rapid one because this is what we're having right now. All right, we should have that. We should have more bonds than the stocks we have. But what we have right now is this. People that don't sell their stocks because they magically believe that even if they have to sell, to panic sell, and sell everyone in the same time, then no worries. We're going to have the super central banker to save our assets and to provide liquidity when it's lacking. But like I said, balance sheets are not infinite. There are rules with asset buying on central bankers. So it is not free to do whatever they want. All right? And people tend to believe that anyway. There is no other solution. There is no alternative, though the central bank will find a way to buy a bond, to buy assets, and they're going to buy the illiquid assets. So, yeah, great. But since when do we have government financing companies, knowing that most of the companies doesn't even pay taxes already? So, yeah, if you do this, you simply say goodbye to governments. Right? The government simply means nothing in the future. If we go for this world, then there is not even a government. Democracy, you say goodbye. Bye-bye. There's no longer going to be democracies. We're going to have superpowers like the Googles and Apples will rule the world. They'll make the laws and they'll decide whether you can do something or can't do it. Yeah, that's a dystopian vision of the future. Yeah, just have a look at sci-fi movies, what they figured out 10 years ago. So, yeah, it's likely just bullshit. It's not going to happen. I don't think it will. It can, obviously. Everything's always possible, but less likely. So what's very likely going to come is that people will get to buy bonds and sell stocks to buy them, because this is the portfolio allocation we're having right now. Asset managers have been buying gold. So what's stupid is that what we have right now is an in-between growth to distribution system. It's a partial distribution, which means asset managers have been buying more safe haven. They're keeping more gold, and they're starting to sell commodities. All right? Okay, these things have been done. So we're currently well exposed with this part of the money shifting. All right, we're into a distribution type of phase for those assets. What's wrong is the way we spread bonds and stocks. And the only way to make it back to a normal distribution system is this: sell stocks, buy bonds. Simple as that. All right? I think that's the only solution in here. So either bond price will keep on increasing forever, which I doubt, or there is a problem with the rates, the interest rates. And in that perspective, people are going to buy bonds, and it can only either increase the asset bubble pricings into bonds, which means people wanting bonds with limited amount of bonds, of quality bonds, so their price will surge like freaking hell. Option number two, we create new bonds with higher yields. And there is no other option. Because that's how it is. Either we increase price or we increase rates. We increase coupons. Normal distribution phase have an average 4 to 6% yielding for bonds emissions. All right. Now people don't want to have that much bonds because the central bankings have been putting pressure on the yields. So nowadays it's not really attractive to be a bond buyer. But do you really think it's not going to show up? I tend to believe that any fucking way, at some points, people will just get to buy bonds. They'll say, all right, the risk doesn't worth the profits on the growth stocks. So it just needs one thing, people starting to sell those assets, and immediately the money will get there. I tend to believe that this is the natural thing we should be. This is the altered version we're currently in, the new paradigm, that the tools that have been used in 2011 and 2012 will allow us to minimize the expositions on bonds and therefore maximize the exposition to stocks. But like I said, I think even trying is just stupid. Those behaviors, they're cyclical. They're into the money manager's mind. They've been doing it for decades and they've been following the same old process. I tend to believe that nowadays they're asking questions like whether they should repeat that cycle or not. So they're just waiting. But I think they're just waiting for a signal to do what they were always doing, selling the growth stocks to buy bonds. So like I said, inside the bond sector, I could have done the same thing because inside this, there is also a rotation. There is a rotation between growth stocks to value stocks and then growth stocks, all right? There is the same rotation among the bond yieldings regarding maturities. Generally, what we do in here is that we get to, let's do, this is something different I should have talked about. I will eventually, we're only 1 hour long and it's getting messy. So, all right, let's just move this thing, damn it. So I'll do it. I should have done that for the French users. All right, so this is bonds rotation. Damn it. Stocks rotation. Remember that the rotation in here is from value stocks to growth stock. The rotation into bonds is from long-term maturity to short-term maturities. All right. This is what creates the yield curve reversion, simply signifying the distribution phase is on motion. All right. So let's say long-term maturities is blue. So more than anything else in here, we need to switch. All right. So remember that in terms of sizing allocation, we have tiny allocation in here. Very tiny. All right, in here we've got the biggest exposition, and in here we're shrinking a bit for an in-between. All right, tack, tack, tack. So the normal bond allocation that we have in portfolios, or in most, like I said, it's a general vision. Not all asset managers are having the same exposition. That's what makes them unique. Right, every trader is unique, but these are big trending behaviors among the entire management communities. All right. So what we do have normally is people asking for more short-term maturity lending, all right, and corporate lending and stuff like that. So they're likely more financing corporations on a quarter-to-quarter basis, like 3 months yieldings are generally the favorable ones in here. So it's generally the most bond emission during growth periods are 3 months and 2 years. All right, so we're providing monetary lending to companies for these expirations, all right, with associated coupons, and generally, as there is a lot of people willing to lend money and a lot of demand, generally yieldings are pretty low inside the rotation, inside the bonds. That's the reason why normally more demand for short-term lendings, meaning their yieldings are lower because the risks are low, all right. So most of the time, during a growth period, people are mostly lending to stocks, leading to companies like corporate bonds, and most likely they're doing it on shorter maturities. So this is short maturity, longer maturities. Generally, we tend to finance corporation at shorter maturities than we do finance government. So into growth periods, people tend to most likely finance companies than financing government deficits, and they generally tend to favor shorter maturities. All right, when we go on to distribution phase, is quite the opposite. We tend to shrink. Okay, we sell a bit of corporate bonds. All right, we reduce indebting, most likely because, all right, those who are still needing debt to create growth and the distribution phase are generally the companies that will die during the recession. All right, so we're not lending money to those corporations, and when we do, we generally tend to call them junk bonds, which means we're asking for pretty fucking high yielding. But there are still some people making it. Right? Like I said, it's never 100% in and out. But we're less financing the corporations because the good one, they're cash positive, so they don't need money. Right? Those who need money are generally the ones who are still not yet positive into cash flow and eventually will be destroyed at the next recessions, or at least will require higher yielding. So in here, the short-term maturity yieldings are significantly rising. Therefore, bond managers tend to not like them, and they favor long-term maturities. So what the asset managers are generally doing in the distribution phase is they're selling growth stocks and they're buying government bonds. All right? And what happens afterwards into the investment phase is out. Not a single or just a tiny, tiny portion, that the tiniest possible portion of bond investment, we're selling the government bonds, all right, and we're buying a lot of bonds, of company credits, like we're lending a lot of money to companies, all right, just like in here. Now think about the psychology, and you'll understand how money circulates through the system and how we create these growth things, because it's a lifetime cycle. All right, what we do is that when we get in here, we've got lots of lending, lots of money available. All right, we spread it throughout companies so they can create growth. We give them the money to grow activity, sell more stuff, create new stuff, finance research and development, buy competitors, not buying competitors, right? It's not the stage. What we do in here is that we have the growth period has been happening. So the distribution phase is generally materialized by risk manager, by money allocators, money managers, less allocating debt. So they're far less financing debt, all right? And they're getting into safer stocks, all right? They're taking profits on the growth stocks. So the big monetary things that happens on the growth to distribution phase is this, all right? It's buying a lot of bonds, and it's generally using this to do this. We're using lots of the stock's money to buy long-term bonds, all right? Do you understand that? And to buy, all right? So the money that were there is getting in here and in here, right? This is the money goes out of here to go there and there, all right? And generally, the bond rotation in here doesn't favor buying value stocks in here. Oh, sorry. Or at least at some point, this sometimes can be, but most of the time, the short-term corporate bond maturities are used to go there. So this is how things generally tend to go, all right? Profit taking in here, and some of this goes to cash, all right? And the rest of it serves to finance cash and gold buying, all right? So out of the end of an economic cycle, this is what asset managers does. They use the profit taking they make out of selling their corporate bonds to buy more government bonds, long-term maturities, all right, to pass for the distribution to investment phase without losing too much value. They're selling the stocks to buy value stocks. They're selling growth stocks to buy a little bit more value stocks, buying gold and buying cash, all right, though just cashing in the gains, all right. And the second rotation, going from distribution to investment, generally means after the market has shrinked value, which means we destroy the companies that weren't creating value. They just bankrupt, all right, which is the normality. After creating growth, those who were left behind doesn't have enough money. They can't find money lending to pay for their bills, so they're generally bankrupting, and that's normal. That's safe and sound. That's normal in a capitalistic world. So we let them bankrupt. All right, those who were investing just lose money, but those who were growth investing just made money as well. So what happens next is that we take the money to buy corporate bonds. So we're getting out of government bonds to buy corporate bonds, so financing companies. And what we do in here is selling the value stocks to buy growth stocks, using a lot of gold to buy stocks, and cash as well. All right, so this is the money transfer. When it goes in here, all right, the bond sector is not necessarily financing. Most of what's financing the early stocks is this. Okay, it's important for you to understand that. And then over the course, all right, when we go from there to there, what's financing more stocks is that we generally tend to shift from lending money to buying stocks. And I hope you're understanding that. Right? Like these things are basically a balance, all right? But in here, this is how it goes. This is the rotation. You need to understand the stocks to bond rotation, all right? When we get distribution, the stocks are financing the bonds, and then they're financing most of the time long-term maturities. Then we're switching to shorter-term maturities, and throughout the economic cycle, we are less likely to give growth, to lend money to corporation, because the good corporation should be cash flow positive, so they don't require more indebtedness. So we're more likely buying their shares rather than lending money. Do you understand that? If you understand that, you understand how money circulates throughout the economy. These are the major moves, all right? And now you might be figuring out, what the hell is that, though? So let's talk about this once and for all, and talk about the little problems we have in... Oh, sorry, let's just finish first. We're going to do this afterwards. So this is what we should have, all right? Oh, sorry, let me just move it out. So this is what we should have nowadays. All right, we should have this. Sorry, we should have that. Sorry, damn it. So I'm going to put labels afterwards so you're not going to get lost. All right. So this is normal way, and this is current status or current distortion. Like I said, this has been introduced by the monetary policies. The monetary policies have been introducing distortions, right? And figuring out if those distortions will actually be well managed till the end, and what's the point of it? How it's going to change the way money circulates in the economy if they succeed, or is this just an illusion? We'll fail and get back to the old usual game, which I tend to believe is the most likely scenario. All right, so. The normal way right now should be we should have more bond stocks, government bonds versus corporate bonds. Problem is, what do? We have quite the opposite. All right, right now people are hesitating to get into 10-year bonds because the U.S. administration is just spending a shit ton of money and is credit negative. All right, like what we're doing should be destroying the dollar, and the dollar is just not destroying. So there is a monetary distortion as well, but what it creates on the bond market, it creates that type of distortion. We should have people buying bonds from the governments, but they don't because they're not buying more. Who's buying more? It's the central bank. All right, we're expecting them to buy bonds because they use it as collateral. So in the asset managers' accounts, the bonds are lended on a day-to-day basis to get cash to buy stocks. So what they do is that all the bonds they really own are very low. Most of the bonds they have are lended for cash to buy stocks for tomorrow for short maturities. They're buying stocks on a day-to-day basis until the machine breaks up. Just like I told you. The day the machine breaks up, they'll buy stocks, or they'll buy bonds. and they'll probably get to normal. So they'll stop lending on the repo market the bonds to the central bank, and they'll rather like to just hold the bonds and not asking for the cash. They'll simply sell the stocks. That's the next move I think is going on. I think in order to get cash, instead of lending money to the central bank, I think asset managers will likely stop asking for the central banking money and just sell the stocks. That's the next move I'm waiting for. The next move is that if we want to go to normal, all right, we're going to study these things, all right, but what we have right now is that they still have a shit ton of corporate debt. This is why the junk bonds are collapsing. They should be nearly collapsing. Like there shouldn't even be a demand for the junk bonds right now. But people are still lending money to those corporations who don't even make profits. We don't know why, but it's because we don't know where to put the money elsewhere. So like I said, the central bank, what it's been doing is been slowing down the distribution process. But I don't nearly think that they've been destroying it. I think what they're trying to do is stupid, because these economic cycles are how these things have been working for decades. I think they're still working out, and I think what the central bankers have been doing is just altering the distribution phase. Not because of what they actually do right now, just because of what they've done during the growth sectors. Because they first altered the investment to growth. So they forced investment to create growth, all right, using QE in 2011, 2012, stuff like that. And it was, I think, not a bad choice. Like I said, I don't think it was stupid to do it back in those days, but the problem is what it has been created is a distorted perception of the distribution phase nowadays, because we think that the central bankers will use the same tools. I don't think they will. I think they will just let us distribute the money at some point. And people tend to believe that what we've had, which I tend to believe is a temporary entry of the central bank into the money circulating system to favor growth. What I think is that people tend to believe that as they got in to force investment into growth, they're just going to stop distribution and force investment again. How stupid that is. We will have that distribution phase because it's absolutely necessary. It's the purge. It's purging the losers to get to create and get money for the future gainers. It's necessary to cash out the previous winners to give it to the future ones. It's necessary that we drop asset prices so we kill those who don't make it. The bad companies, they're just surviving right now because they still can manage to have lendings. Like they still have money getting in so they can at least survive to the next month. That's what we do have right now. Junk bonds, companies that don't make cash at the end of an economic cycle, are companies that just needs to die. Because the purge is necessary so the wealth can be redistributed and creating future growth. It's just as stupid to think that we can alter the process and have growth afterwards. In the current process, if we don't purge, there will be no growth. And people just don't get it. But it is simple. And I think, anyway, we have a choice. Either we're going to keep on going in that paradigm, like making companies surviving by giving them money just to survive the day right after because we don't want the market to crash. All right? Though what's going to create is going to keep on inflating stock bubble, because as the people still hesitating on whether we should use the growth paradigm or we should switch to full distribution. Nowadays, the asset managers don't know what to do. They're hesitating on whether you should keep on using part of our growth processes, but we can still need to use distribution because we don't know yet. All right? The central bankers want the growth period to keep on going, but it's late. The economic cycle is there. There's no more profits to expect. So anyway, the distribution phase is the natural way we should be right now. Though the central banking system is altering something that is natural, and I tend to believe that nature will prove its own rights. Though I think what we're having right now is just that we're going to have a huge movement later on, which will probably cause collapsing into the junk bonds, which I tend to believe that what we'll have in here is that we should have, when I say this, it's likely like an 80 to 20% in here. So very, very few bonds at the end of economic cycle. Like normally corporations who are in debt very much fail to get more money. That's what create their bankruptcies basically. Right? So we should get there. All right, we should have something like that, and way more government bonds to avoid losing too much wealth when the stocks are purging. All right, so this is what goes in. Normally asset managers do this. All right, they're gonna sell this to buy that. All right, so a little bit of the money that were there will get in here. All right, but mostly what's important is that most of the money to buy this will get from there. So the next rotation normally is from growth stock to be sold in order to get to government bonds. That should be the normal things. Normally same thing, selling the junk bonds to buy government bonds. That's what should be the next step. All right? So that's what I think is down the corner. That's my speculative call. It's speculative, but I'm betting on the fact that the current distortion will fade out and that we just can't avoid getting into distribution. That instead of going from growth to distribution, we just have been for a long growth period, extended growth to finally get to distribution. Let me show you what that looks like in terms of asset pricings so you'll understand, and then I'll talk about that. Yeah, let me zoom out. Let me just take a chart. All right, so this is the Dow Jones. Let's scroll back to 1987 because that's exactly the current context we're in. All right. All right, this is brutal monetary redistribution, and I think that what we've done recently is just the same old thing. All right, so back in those days, let's just use a split chart. Dow Jones weekly, yeah. All right. So let's take the economic cycle, 1987 as well. All right. So as you can see, sideways action, base valuations, exactly what we've done with the Dow Jones previously. Then trend is emerging. All right. Okay. We create a trend channel. We break out of it, pull back, and then bam, the market goes overextended. This is where we've got the final excess irrationality, like the excessive market. But this is not a bubble. This is an excessive market. That's what we have right now. We have a market excess. We have no bubble yet. That doesn't mean that we can't switch to a bubble. All it says that the current market we have is a market excess. Though, back in 1987, this excess has been rapidly purged. Prices rapidly reintegrated the previous channel, trend channel, made another support in here after recovering. All right. So if you put it in motion, this is what happened. After the market top, the market significantly purged, recovered, and got back to value. All right. 3 cycles. This was very distorted distribution. So the distribution phase started there. It has been overextended. So normally this is where the market should have made a correction. It should have done something like that and then recover. But instead, we've done overextended, rapid drop, and recovery. All right? Recovery, slow recovery, and then fast. To end up the same way, right? 2 different ways of doing things. Now, this is what we've done right in here right now. So, the growth, all right, we create the trend channel. All right, so, sorry, not this one. Oh, damn it. Though the trend channel in here is there. All right, like we created this trend channel. All right, so we get out of here. This is the trending system in here. This is the trend in here. We get to go sideways and then final excess. So sideways, pull back on the trend channel, final excess. So we're currently dealing with it. So maybe we're just there and we still have that to do. It's still hard to figure out, all right? The majority of this thing is pretty fucking complex. So maybe, yes, there is still a little bit of growth to come. Eventually, just like I said, what I care about is how to portfolio allocate within the next few years. What the next big move is. And I still tend to believe that time is ticking within either this thing show up and we're going to have an ugly reversal and we're just going to play the same old game. But what I think is that that's what we've had done in 2018. We built the market top. I think we've done it. I think we should nearly have gone there and only, all right, like this, what we're experiencing since then, is just noise by that distortion that has been introduced. I think if central bankers hasn't been supporting prices by aggressive rate cutting, we would be there. We would have done the same old thing in 1987. I can't say, because obviously we can't know what alternate reality we could have been if there was no central banking interventions. All right? But what I believe personally, and that's a belief, there's, like I said, I'm not going to trade that unless I have technicals. So like I said, I think that we have weekly bearish cycle coming along the way, but I'm not sure. And if they're not, then we'll be there and we'll break up on the weekly basis, though I'm going to wait for a few months, and I've been clear on that, and then I'll try again. All right? That's my plan. I'm not going to sell forever. I have timings to sell, and if they break up, I'll wait for another timing after the breakout. I doubt it is. And if that is, like if we're really breaking up this resistance in here, I know what I'm going to sell. All right, like the Dow Jones next selling area is going to be 32,000. Just the usual range structure, just like we've done back then. Look at that. We were accumulating, breaking up, we just doubled up, and then end of the story. So yeah, I'm already knowing where I'm going to be selling next, if that's what we're going for. I don't know. I just have plans. That's what you need to figure out. So if we're done, and if that is just a distortion, all right, then what I think is that this is what we should have done if we were in the 1997 kind of things, all right. So I'm sorry, it doesn't take that long. I've done this for the French guys. If you take the bottom in here, all right, bottom to top, and out of the recovery afterwards, it's approximately 1/3, all right. So divide this into 3 parts, and you get the recovery phase. Just take approximately 1/3 of the global cycle, right? Like going up, down, and up in here. So if you do the same thing in here, if you assess that this was the theoretical market top, 1/3 just basically give us to 2022, all right? It can take a little bit more, 2023 if you want to be extended. So considering out that this is what we should have done, then, all right? So it means, yes, we've been creating a distortion because of the central banker, but if they fail, and if the money managers just make the major rotation I've been talking about, like they start selling huge the junk bonds to buy government bonds, and start selling their growth stocks to buy some bonds as well, then yeah, if they're selling stocks, growth stocks, and no one's buying them, then yes, obviously price will sharply drop. But that's just normal. That's the normal pricing. So if we do this, what do you think is going to happen with those growth stocks that are fully loaded in the Dow Jones? I think Dow Jones would just go back to reality. Yeah, I think that's the future, like catching up to what we should be in here. What I think is that instead, the investment phase, like this, all right, when we drop prices is what I call the investment phase. Normally, you've got a long investment phase after this type of crash. Like in 1987, we've been basically spending a full year. And remember that the cycle is significantly different. In here, the cycle took 6 years to build itself to the upside. We're 10 years in, so the cycle length is significantly different. It took 2 years to recover afterwards, probably going to take 3 years for us in terms of actual amplitude. That's absolutely very averaging in here. We can't just use those information. Timing is always complicated, but just gives you an average number. Might be taking 3 years to recover, starting from 2018. So I tend to believe 21, 22 is what we actually need before recovering. So the longer we hold in here, I think the fastest will be the investment phase, all right? So I think that anyway, this thing is somehow inevitable, because I think these are the prices that the smart money wants to buy stocks. Buy new stocks or rebuy old stocks. And in that perspective, yeah, I tend to believe stock market drop still down the corner. But like I said, multiple options. Either the smart money manager will still believe that the central bankers are in control, and what we'll have is that eventually we can overextend, create a bubble, but we'll have to pay for this with an even sharper drop afterwards. All right, like it's the same old thing. We're going to go back to these prices anyway. All right, so we can go higher anyway. Yeah, that's possible. Going 34, 35K, 37. What's going to happen next is that anyway we're going to 16K. So I have no big deal with that. I mean, if the end is to go there, why the hell would I buy that? All I care is to buy there. all I care right now is the investment phase for Dow Jones. I still tend to believe it's 16K, 20K at best, but probably no more than this. So I'm just patient. Like I said, I'm not going to buy this. I don't care about that. I'm going to let those prices to whoever is stupid enough to buy, because there's too much risk to lose valuations afterwards. So this is what I care. There's a choice you have to make right now. Either you think the central banking system will have it under control perfectly, and they're not going to create bubbles, like they're not going to create an overextended prices on assets, and the investment phase will be rippled out throughout the multiple drops that we can make in this ugly sideways range, like in which we lose 20%, then recover, lose 20%, recover. And I think we need to do this for at least 2020, and eventually in 2021, 22, we might be able to recover, meaning that we catch up with reality and we can grow again, create a new growth cycle. So instead of doing this, we do this. And then we'll recover, right? But I think that's possible. That's something that seems to be realistic, because generally markets tend to choose the in-between way. I don't think that what we're living right now is the irrational exuberance and stuff like that. People might want to believe it because they rather like to have something to keep on going. So I tend to believe the market generally tends to find the in-between thing, which means those who think that the cataclysm is down the corner, we're going to drop 40%, I think we have to leave an open door for this, just in case. But I don't really think that's the absolute most probable thing. I think the central banker will try to have it under control, and if they do, then I think volatility will keep on shrinking. But are we going to keep on shrinking out of the current levels? I doubt it. I really, really doubt it. I think volatility is going to pop up again. At least I hope so. I'm going to wait for it, because like I said, I've been speculating enough. I don't want to go down more speculative trades in Wall Street right now, though I'm just going to wait for clear and clean signal that the volatility is rising again. And we'll see. Either we get to 50 and that's it, like the volatility doesn't go out of control, we go to shit, rapid drop, people panic, and then we're fine, like we're dropping 20% in Wall Street, we get there, and end of the story. If we have that, then I think the future might be something like that. And then we're good. Not 2023, like I said, just doing this like a couple times, couple swings afterwards, and I think we'll be good to go again. But I think there is not even a chance we can go higher. If we do, yeah, 35K, and then bang, 16K. And now we're going to have an economic crisis, because you can't drop prices by half without creating side effect on the real economy. So you can't play with the magical tool that is financial market, which is a derivative from reality, all right, like money allocation for real economy. If we fuck it up, then we're going to have to pay the prices, which means some companies in here will be really ruined, lots of debt will be destroyed, and the consequences will be significant. So I better hope we don't go down this road, because what's gonna do? If we play that game, we're going to have at best 1.5 years of growth. And it's going to be a stupid growth, creating even more wealth gaps and stuff like that, and then end of the story. So think about it. You want Trump to be re-elected, he's probably going to have the biggest crash ever right after his election. I can tell you that for sure. If Trump gets re-elected, we're probably going to have the biggest crash ever afterwards. Something significantly to be remembered. So, yeah, go for it. Go re-elect Trump if you want to. What's going to come next is disappointment is down the corner. And you're going to have this fucking guy in office for the next 3 years. After the crash. Like I said, re-elect him for 4 years. First year or first 6 months might be nice, and then bam, reality. And then you're going to have to face the asshole on the office for 3 more years. And it's going to be a pain in the ass to have him in office. So anyway, I shouldn't have said that. This is political vision, and I shouldn't nearly be sharing those things in here. So anyway, I hope you've been learning something. Oh, sorry, I was forgetting about the final part. Sorry, let's get to this. Alright, let's get back to one chart. Alright, there's one part I haven't been talking about, so let's do it right now. Okay, so what is this? I'll explain. So this is smart money. Alright, This is what I sometimes call dumb money, even if I shouldn't be using those nasty words. It's just because, I mean, I have to use words, so call that better money and less better money, if you like it that way, all right? But I like to say professionals and retails, right? That's probably the least insulting way to say it. This is a professional way of allocating money. This is retail way of allocating money. So this is how it goes, all right? So consider this as snapshots, all right? But the reality is something that is more oscillating, all right? So these are cycles, all right, in which I took snapshots, and when the growth, distribution, and investment. But those things is like, all right, when we go investment, all right, the retails have the lowest amount of money because we just came out of recession or financial crisis. So retails have a low amount of money. Then growth is starting, all right? Let's just use a chart in here. So let's say, all right, this is investment, all right? This is the growth, all right? And this is the distribution phase. Yeah, well, go investment. Okay, and so in here you got investment phase, which is prior. So we invest in here. This is the switch, we get into growth. All right, this is the switch, we get into distribution, and this is the switch back into investment. This is how it looks like, all right? During the investment phase, people have no money, all right? The growth starting to happen, money is starting to ripple through the economy, all right? People getting money, the economy stagnates, drop, and we're back for another cycle. All right, investment, growth. All right, figured out the cycle. All right, so figure this out. Right? That's what this chart represents. Low amount of incomes and money. Lower incomes when after the drop in price and during the investment phase, people have fewer amounts of money. Right? Less money because either there was an economic crisis or there was a financial crisis and therefore their savings have been slashed, or economic crisis and therefore unemployment, lower salary, lower paychecks and stuff like that. All right? So less money available to invest. Let's call it that way, pure and simply. All right? So what do people do with that? All right? When they do this, all right, generally means they have less money to invest. Okay, that's a simple way of thinking things. All right, sorry. So in here, the two colors represent something different. This is actual active investment, like buying stocks and stuff like that, like the money they allocate for savings. All right. So let's assume that's the money you have. How much do you give of that money for savings? All right. So for future wealth expectations, and how much do you get to consume? All right, this is consumption levels. All right, so this is what happens with the retails. All right, when the investment phase goes in, all right, most of their asset allocation is to consumption. Oh, and I should be going this one further. Right, they're not investing, or really barely. Like the money they can make, the few dollars they can get, they will mostly spend them to consume, right? Like consumer goods, the minimum goods, like buying something to eat, paying for your rent, stuff like that. Like the minimum requirement to live, all right? So most of it goes there, all right? So tiny bit of money gets to invest, or not at all for those who are the less wealthiest. So as it goes through the investment phase, when in the meantime, all right, the asset managers are rotating, all right, they're getting out of defensive stocks to buy growth stocks or potential growth stocks, and they're selling bonds to get to finance companies and buy stocks. What are people doing? They're just paying for their rents and paying for their shit, for their goods, for the minimum livings, all right? They're not investing when the smart money is actually actively investing. They're taking the money and rotating it to riskier areas, all right? Then what happens? Those riskier areas create wealth, so at some point they start increasing the paycheck, but with really a lagging purpose, which means if you take people's wealth doing an economic cycle, it's lagging, and at the end, money is really going fast and creates some kind of a bubble, all right? So the stock market does something like that, all right? Like that, and that, all right? And people get to do this with their livings and savings. So when they should invest, and when the smart money does invest, they have no money, so they barely invest, or they don't even think about it. They just think about surviving to the next month or something like that. As the economy is creating value, they're less profiting from this value, but still they're investing a bit. So if they can make a tiny extra money, they're going to invest it, buy a little bit of stocks and profit from this to increase their asset global, their global portfolios, their global value in the economy, all right? And as the distribution phase starts in, all right, like in here, people are the wealthiest they've ever been. Their bubble is going on. They're getting rich because paychecks are rising, full employment, stuff like that, consumers' confidence at its best, your accounts are full loaded in cash. So what do? You invest. That's great. That's when people are getting from consumption to investment. They say, all right, I've got whatever I need. I bought all the shit I could. I've got the best possible TV. So until the next generation or whatever. And moreover, at the end of economic cycle, innovation is less likely coming up. So you have less willing to buy more stuff because there's less invention. Just like I told you, you've got an iPhone 10. What the fuck do you care about the iPhone 11? You know it's not going to be a revolution, so you say, all right, I'm maybe not going to buy this one, or maybe I'm going to buy the iPhone 12 or 13 or something like that. I'm going to buy 2 generations away from now. I'm not necessarily wanting the next stuff, absolutely. So we're shrinking a bit consumption, shrinking a bit, just like I said, which is putting pressures on the caps as well, all right? It's helping capping up by consumption going not significantly, but slowly fading away. As consumption fades away because of less innovation, we're already creating the roots for the market drop, all right? This is things where things actually rotate. When the consumption gets lowered because people think we're not longer innovating, and they rather like to spend their money into saving. That's the moment they think it is about time to invest. So what do? They create the market final excess. Obviously, they're coming in the late stage markets. They're creating tiny bubbles sometimes. But anyway, they're buying and they're investing. Great. And obviously, what happens next? Slashed investment. They'll lose money and we start all over again. So now you understand why I told you at the end of economic cycle, generally the dumb money, which is the retail money, is generally doing the opposite of what they think they should do because they have money and they think it's about time to save for the future. As they shouldn't be fucking doing it. That's the worst fucking thing to do. Now we could add something in here at like credit exposition. I'm going to go full circle around in here, all right? What we can add regarding retails is that how they allocate credit. Remember that we've done stock expositions. So consider cash they have and how much they buy stocks. All right. And now let's consider how much they get credit. All right. What do? All right. What people do is that when we are at the end of economic cycle, yields are pretty fucking low. So what do? They endebt themselves to buy stocks. So they're using debt leverage in here, which not everyone, all right, like I said, not everyone is doing this. But the level of indebtedness is significantly rising at the end of economic cycle. Like people feel like they're rich and they can only be richer. So when they have to buy a TV, they're not going to buy the $1,000 TV. They're going to buy the $2,000 TV with a 4 times delayed payment. This is credit, right? They're using way more credit at the end of economic cycle because they feel like the good condition and the improving conditions will keep on going. That's the usual candid way of seeing things, all right? But obviously, when they get there, they're ruined, so they have absolutely no investment capacities. If they go see the bankers just say, all right, you're not liquid, so I'm not lending you money. when this is where they should do. Like, they should keep money to lend some fucking money in here. I'm going to explain you what people do wrong and how and the way they should do if they wanted to make money out of economic cycles. So they're getting credit when they shouldn't, simply because they think the way they're living, they're improving their living conditions, are going to go forever. Problem, we're already late on the economic cycle, so they can sustain for a bit, buying great TV and stuff like that, buying more expensive stuff that they shouldn't have, they can't afford, and then doing it with credit leverage, which put them at even more danger of losing money in here. Because remember that credit is something that you're going to have to pay later on. So if the shit really hits the fan, your actual incomes will be even more shrinked out because you had debt on top of them. All right? Like, take that, the amount of money, like take the whole square. If you're adding credit to be refunded afterwards, then it means this is what you've got less to consume. All right? So the more credit we've got, the more dangerous that will be into the contraction phase, because when investment will be needed, you'll have even less money available to spend. So having over-indebtment at the end of an economic cycle is dangerous because it has a slowdown effect on the recovery. That's important things that you need to understand, all right? So the problem is when people should indebt at the end, at the beginning, at the investment phase, they should be indebting to buy stocks, just like the smart money does. They can't because they're ruined and no one wants to lend them money. Because those guys, the lenders, who the hell do you think they're going to lend money to? They're going to lend the fucking money to corporation instead of lending to retails, right? They're going to lend to retails that have some money and save money afterwards. But those who are in the least favorable conditions, do you really think they're going to be able to have any fucking credit line? They just can't. They might be not even asking because they know they're going to get shit. Then what happens afterwards? During the growth period, people are indebting a bit when they should be indebting a lot. When they make money, instead of buying fucking stuff, they should be buying investments to get to grow their capital. This is during the growth phase that you need to buy credits, to buy stuff, and instead of consuming your money, you should lend the fucking money to buy more investment. What people do is this, right? They indebt themselves at the end of economic cycle to buy stuff they don't need, buy stocks, whatever. They're going to go and say, all right, the S&P 500 costs 50,000. I don't have it, but let's give me a 2 times or 3 times leverage so I can get really a lot of money. Obviously, that's stupid as hell. I'm just taking the worst case scenario. Not everyone is doing this, all right? But what people should do is the opposite. What people should do is getting to indebt a lot when the monetary system is creating value so they can participate and buy stocks, all right? They should stop using credit at the end of the economic cycle and consume out of what they have and save with the money they make, all right? Not trying to use leverage on their savings, and indebt a bit in here to maintain sustainable living, all right? Because in here, when you have less money available, maybe, I don't know, someone in the family is losing jobs, so you have less income, or is working part-time, but because the working conditions are worsening. Though, if this happens, you can compensate with a little bit of credit. And in that perspective, what you do is that you maintain a sustainable level of wealth, and you smartly invest and use credit when it's good to do so. But the problem is people think dumb because they have a look at the yieldings themselves to figure out if they should use credit or not. When the yields are low, like when we shrink them at the end of economic cycle, they think it's the time to invest and to lend money to invest. Worst case scenario, that's obviously the worst timing to do so. But they think low yields is attractive, so I'm getting here. It's discount credits. It's discount because it's the fucking worst time to do it. When the yields are increasing, as growth is going up, all right, this is, all right, who cares? Yes, the yields are rising a bit. Who gives a fucking shit? Anyway, there's inflation, there's monetary creation, there's wealth creation. Get to use the fucking money to invest in where the wealth is creating, instead of just waiting for your paychecks to rise. What you do is that doing this, you have a living condition that is flattened, which means you're not poor when the shit hits the fan. You're maintaining very interesting, sustainable way of living, and that's cool. And you're not over living when the economical conditions are great. You're just living good. You don't need to be great. You don't need to have the bigger fucking TV. All right, that's not how it goes. People are indebting themselves out of end of economic cycle. Let them do the stupid decisions. You'll take the better ones. That's simple as that. What I can tell is that it's not complicated to act like a smart money manager. You just have not to follow the DOMs. And when I say dumb, I say just retails. But like I say, I do understand the processes. I do understand that some people who don't really understand how finance works will like to jump on cheap credit at the end of economic cycle and take stupid risks like buying really expensive stocks and instead of buying bonds. Listen to people right now. They'll say, all right, the governments, they're so indebted, I'll never get to lend money to the government. I'd rather like to buy apples and buy things like that because this is the future. This is where the money will actually end up. Do you really think that is? I mean, I don't know, but it's very less likely going to happen. The next move is more likely that the smart money will say, all right, enough of this game. Now I'm going to buy some corporate bond. I'm going to sell my corporate bonds. I'm going to buy some government bonds to go safe haven. And I'll let the fucking stocks to whoever bought them. And probably those guys. They do the opposite of what the smart money is doing. I can't hardly explain how stupid that is. All I can explain is that it's understandable. I understand why they do this, just because they don't know how things works. I hope you do know and do understand that right now. That doesn't mean the next move is obviously be the one I told you about. It's just the most likely one. Not the only one, and you'll never be able to forecast the future. But if you understand risk management, I mean, today is an expert podcast, so I hope you do know risk management. That means in here, even if that's the most probable scenario, you simply can't bet your future on this one. Because we could have a tiny bubble, that would be the worst case scenario. If the bubble shows up, then we'll have a more significant downside drop afterwards. But anyway, do you want to be among the dumps? Do you want to be doing this, like making gains for a year at the risk of losing half of your capital 2 years from now? That's not a smart investment. Though you can do it short term. Like I said, out of a 1 year scale, you can definitely buy short term. But can you do it now? We're barely trying to cross the resistance at the moment. So we're trying to means it can just be a trap. And if you start buying right now at the market top, you might be doing the worst decision. We've been watching the ETF recently, meaning that this is the most popular asset among retail traders right now, which means not just the retails. I mean, some smart investors are also using ETFs to protect capital, but not just it. Most of them are retail. It's a very, very fancy product for retails right now. And as we've seen, ETF is the most demanded product right now, and mostly share ETF. So people are buying shares, and they're buying bulk. They're buying either sectorial iShares products, or they're even buying the iShare XPX. They're buying the whole thing. The problem is what they think. That's another very profound misconceptions of things work. They say and they think that, because that's the thing I've been hearing recently. So that's one of the many reasons I'm making this podcast. People just tend to tell me that, Phil, no matter what happens, governments are not the way to go. So there's no alternative. We need to buy stocks. And even if some stocks end up being sold, some other will be bought. And by buying the SPX, you're sure to save your wealth and to be prepared for the distribution drawdown. So they end up telling me that the most rational decision to make for this distribution is to get to buy bulk stock. So, like I said, what retails think? They think that by buying the SPX, they'll be safe and sound. Now let me explain what the problem is. What are you buying? What's in there? Let me give you a second. All right, let's have a look at this. No, it's not a screener, it's the heat map I want. All right, this is the SPX. All right, this is the portions of SPX. Now, if we could split that into value stocks versus growth stocks, all right, into the SPX, the average spreading between growth stocks and value stocks is approximately 70% of growth stocks and 30% of value stocks, which means if the next rotation, the smart money rotation, all right, is going, they bought those stocks, all right, and they've been underperforming that, if that's the next move, like I said, they're going to be selling their growth stocks in order to buy bonds. So if they're selling these stocks, what do you think is going to happen with the indices? If well, it's not 70, but it's more likely a 65-35. So if 65% of the big broad indices, even the SPX, are loaded in with growth stocks, what the hell do you think it's going to happen? If the growth stock sector just loses like an average 30 to 40% drop, which is what we've got generally on those contexts, if they lose 40%, then what the hell do you think is going to happen with the stock market itself? Even if the value stocks sustain valuations or if it gain a bit, it's going to be marginal. Most of the asset classes will lose value, which means that global indices will fall. So those who are buying bulk will lose significant amount of money. They might be losing 30%. Yeah, that's not that big deal, all right? If you can afford losing 30%, like we said, there is going to be an investment phase and then recovery. So if you're buying right before the 30% discount, it's not necessarily a big deal. The only thing you must not do is buy to sell. But just like I said, people are projecting their actual condition, thinking that what's going to happen a year from now is not going to change because good consumer confidence, strong economy, Donald Trump just repeating that shit all over again. So people tend to believe that what they're living right now is going to be the same 1 year from now. So they say, all right, even if I buy the XPX, even if it loses 30%, I'm ready to take it. I'm ready to wait for 2 to 3 years. That's what most people tell me when I tell them this story. They say, all right, if I have to lose 30%, I'm fine with that. I'm going to survive. And if the market goes up afterwards, then maybe I haven't been taking the smartest decision as investing at the lows. I might have bought the top, but anyway, we'll go higher. That's what I tell. Anyway, we'll go higher. And where's the risk? Where is the money management? What's the plan? What if anything doesn't go according to that plan? What if you just missed something? Oh, well, that's it. I'm going to lose the money. That's the answer I get. When someone tells me that, I can tell you just one thing. I'm going to pick their money. It's simple as that. If you're willing to lose that money, it means someone will take a smarter decision and probably pick it. So I don't know how we'll do it. All I can tell is that those guys, when they're stupidly reacting like that, in a way that is simply not fitting anything to investment, but gambling. I mean, you're thinking something is going to happen. You're thinking that any fucking way, if something goes wrong, you'll manage it. Fucking hell, you have no plan. You're going to react when things will happen, which means I don't know what the distribution phase may look like and how the market drop may look like. All I can say is that I think anyway something unexpected will show up for you. Either your capital will so rapidly shrink that you will not be able to pay for expenses, which means you're going to have to sell your fucking investment whether you like it or not. You'll be forced to sell. Other case is that the ones who have been using credit to buy more stocks than they could afford, those who have been using triple bull S&P 500 or something like that, all those guys, we lose 30%, they lose everything. No dollar, zero, bankrupt by the market maker. But the other hidden problem we've talked about significant numbers of times is that investing into something needs to answer 3 fucking questions. What are you buying? For what purpose? And who's buying on the opposite direction? And who's selling if you're buying? Who's selling that product? Now think about it. Though the thing that we must absolutely not do right now is being a retail trader, totally unaware of how the system works. Buying ETF. You're not even buying stocks. You're buying ETFs, which means who's selling that ETF? BlackRock. Great. Now how liquid is that asset? You don't know. You don't know. Like I told you, the problem with iShares is that the liquid value of those things comes at the last sold price, which means if we oversold stocks, just one stocks, the value of your portfolio is significantly shrinked instantly. The other problem is that if only one asset among the package you have is illiquid, you can't sell. Though there is some insurance for this, obviously it can be more complex, but most people just bought something, they don't know what that is, they don't know how it works. They just know that anyway, if something happens, it will be dampened by the fact that I've been buying multiple shares. Like, I just bought 500 shares, so it just can't lose money. It just can't lose it all. I just can't lose it all. No, you can't lose it all unless you've been using credit to buy it, which means using leverage, and unless you're going to need the money more than you think you need to hold on in stocks. Because regarding the problem is the recovery phase is slow, which means you have money invested, that money has been losing 30%, and you got to watch your account every day. You need money to pay for your bills, and every day you have a look at your saving account and say, fuck that, I bought the market top, now we're 30% lower, and the market isn't recovering. Believe me, those guys, they're not psychologically prepared for this. Maybe you are, as you got experienced traders, though you figure out that patience is the key, and I believe that you can survive these things. Though if you buy right now, I think you'll be fine. But those who are buying right now, they won't. They have those biases you had back in those days. What do you think they're going to be doing? They're not going to sell the first day, but they will sell sooner or later because they'll need the money to buy stuff. And they'll think about, all right, fuck that, the SPX, those Wall Street guys, they fucked us once again. That's what they'll say because that's what they say every fucking crisis. They get fucked up and they say, oh, I knew it. God damn it. I shouldn't have bought those stocks. Now I'm going to focus on the essential, feeding my family, paying for my rent, focus on the living, focus on the essential. They just had a glimpse of what investment is, just the worst paced. Just the worst part of it, simply because instead of thinking, they just got into something they don't understand without understanding what products they were buying, for what reason. They just didn't want to understand. They just wanted to make easy money. Just like I told you, that's why I call that smart money versus dumb money. The dumbs are the ones getting in here without a single bit of knowledge versus guys who are doing it for decades. Who the hell do you think is managing the money in the world? The dumbs that don't know shit or the smart money? When I say dumb, I just said unexperienced people. The word is rude to say dumb. We're all dumb. I'm dumb in some cases. There are lots of things I don't know about, but I don't try them, all right? Like, I don't know. Let's just take a stupid example. Am I a runner? Am I going to go now playing the marathon tomorrow? Fuck no. I'm not ready for it. I'm not prepared for this. Do you really think I'm going to be even trying it? Though, would I even bet on my future on this? Like, I make make a big bet, like saying, all right, I bet you $20,000 I'm going to make it to the end of the marathon. I'm not even ready for it. I don't run ever, but for $20,000, I'm going to make it till the end. Yeah, all right, I'm going to take the bet. You're probably going to lose. I mean, if I can't afford those $20,000, I'm going to take the bet against you. Even if, yeah, you're just unprepared. It's simple as that. I know the comparison in here is ugly, but that's really what happens. The smart money always end up picking the dumb money just because those guys make bad decisions. We can't force them. I can't tell that we don't incite them to. That's another topic and that's another question. But all I can tell is I'm not forcing anyone to make the calls right now. Those who do it, they do it on their own. I'm not telling you to sell the market either. All I can tell you is that right now is a tricky moment because we're living in a distorted market and God knows what's coming next. Either the distortion will stop and we'll go back to reality and all we'll have managed to do is just saving a little bit of time to shrink the investment timing. That's what I believe. I think that we're going to just return to normality in a brutal way and that all we'll have done in here is that instead of spending a year to the bottom, we're probably just going to spend a few months. Like it's going to be a rapid recovery. That's what I think. That's the reason why I told you I don't believe in an endless, painful recession that goes rippling into the economy and stuff like that. I think just a shock, a redistribution. rapid redistribution, and we're in a rapid recovery. Like, I tend to believe that, yeah, probably a year and a half from now, maybe 2 years, we'd probably be dealing with the same prices we're dealing right now. Obviously, if not something unexpected show up in between, like an ugly war or something like that. Despite really black swan type of things, I tend to believe that even if we have a significant price drop to redistribute the money, yeah, I think the investment phase following will likely be faster than an average cycle. All right, that being said, 2 hours video today, really a long one, but I wanted to go really deep into these processes. So for 2 reasons. First of all, stop telling me I'm wrong or whatever. I don't give a shit. I have my plan and I'll follow it anyway. I'm risk taking and risk managing, all right? But you don't do this if you're experienced. But secondly, if I do this, it's for you to explain and to understand that I don't do random stuff. It's not just a bet because I'm a perma-bearish guy. No, I really understand part of those processes. Just like I said, I don't understand how market works. These are patterns. These are things that works within chaos. They don't work 100% time. But these are patterns, just like all the patterns I use. But now I think today I took 2 hours to explain fully details pattern of what I get about macroeconomic cycles, how to profit from them, and why the current one we're having is distorted because of one more market participant being introduced over the latest years. People will obviously believe that this market participant will have a growing effect on the future, as it's been growing over the latest few years. The market central banking system has been being more and more introduced in the market and like acting on the markets, and people just want to project what happened. They think the central banking will be there forever and in an increasingly powerful manner. I tend to believe it was just a timed introduction to just save us from the 2008 crisis, which was a systematic crisis and created economic repercussions. I think that the crisis we might have forthcoming will not. I don't think we'll even have consequences on the economy because it's going to be a faster drop. Though the thing we need to do right now is just not making the bad decision. That's what I think. Just don't be dumb. Don't leverage yourself to get into markets. Though obviously you're experienced, so you don't know that. But this is exactly what people are doing right now. They're buying iShares, iShares, iShares. Just have a look at the SPX versus ETF. I mean, we're making new market tops every fucking day. Those guys have no fear. They don't fear. They're investing. They're getting more and more and more and more in the market. Oh, they're starting going out. So that might be an interesting thing. Right? When this thing crosses down, means ETFs will start to be sold. All right. So we'll see about that. But just like I told you, many significant problems down the corner. Volatility might be peaking up. We have junk bonds inching down. I mean, you do whatever you think with that. All I can tell is that this is not good news. And all we're waiting for is to see how it reacts when we're asking out in ETFs. We'll see if there's enough money for everyone. I doubt it. We'll see. Bye, guys. Have a good weekend. See you next week. This one was a really long one, but I hope you'll enjoy it anyway. I can't go into any more details than the one I've been explaining today. Lots of you guys wanted to have a better understanding of macroeconomic rotations. Now I think I just explained it as much as I could.